Hello guys, welcome back to today's video. In today's video, we are going to be talking about market structure in trading and how you can use market structure to profit in trading. So let's straight get into it. Market structure is the basics of trading and it's one of the most important aspects of trading which we should understand. If you have ever felt confused about the trends, the entries, or why price suddenly reversed in that particular area, this video will hopefully make everything clear. Alright, so market structure. What is market structure again? Market structure is the natural movement of price. It shows you where the market wants to go and where we should expect it to go next. And this market moves because the institutions make it move. Who are these institutions? They are central banks, commercial banks, hedge funds, corporations, asset managers, and a few more to name off. They are the big players, we can say. So there are three types of market structure. Okay, first there is a uptrend where we know in an uptrend price moves in high, low, higher high, higher lows. Okay, price keeps on forming higher highs and higher lows. Okay, higher highs and higher lows. Whereas in a downtrend, price forms lower lows and lower highs. You have a low, a high, a lower low, a lower high, lower low, lower high. This is how price moves in a downtrend. Whereas there is a third type of market structure which is known as sideways, where price does not form a clear higher high or higher low. Price just forms a high and a low. Okay, you can see in this sideways structure, also known as ranging, there is no clear direction. Okay, price goes up and comes down, goes up, comes down. It There is no clear direction on where price wants to move next. In these types of market, we usually want to wait and we want to wait for a clear direction so that we can know what we can expect next. Okay, so in these market conditions, we usually stay out of the market. These are the three types of market structure which we have in trading. Now let's look at another important aspect, key aspect which we should take note of, which is swing highs and swing lows. What are swing highs and swing lows? If you see here, these are known as swing highs. Okay, swing highs, swing high. This is another swing high, and the basically the highs are known as a swing high, and the lows are known as swing low. Okay, the lows which we have here, these are known as swing low. This is swing low. This is a swing low, and this is a swing low. Okay, so let's look at the examples on the chart. So you can see here where is the swing lows and swing highs. We have a swing low here. Why is this a swing low? Because we have a low to the left of it and we have another low to the right of it. So this is the low which is at the lowest at this point. So this is known as a swing low. This is known as a swing low because we have a low to the left and right of it. We have a low here and a low here. Even this is known as a swing low. Why is this a swing low? Because we have a low to the left and the right of it. Okay, and we could even say this is a swing low. Okay, so this is how you can identify a swing low. Now this right here, we cannot say it's a swing low because we have another low higher than this low, so this cannot be the swing low. A swing low has to have a low to the left and the right of it. Okay, so that is a swing low, and when we inverse it, that is what we get as a swing high. So this is a swing high here, right here, and because we have a high to the left and right of it, and this one is a swing high. We have a high to the left and right of it. This is a swing high. Why is this a swing high? Because we have a high to the left and the right of it, and again this one is a swing high. Okay, so this is a swing high. So I hope it's clear now what is swing high and this is quite simple to identify the swing high and swing lows. As how we have discussed earlier, an uptrend is when price makes higher highs and higher lows, right? So in this example, you can see price is making higher highs and higher lows, where price forms a high here, high, low, higher high, higher low, higher high. Here price did form a lower low, but then it just continued higher, so high. So it is still continuing the uptrend. Okay, we have a high, higher low, higher high. we can see this is known as an uptrend, whereas in a downtrend have price making lower lows and lower highs. Okay, we have a low, a high, a lower low, a lower high, lower low. So this is known as a downtrend. Okay, and if let's say you want to see an example of sideways in the market, this area here, right here, this is known as a sideways. Why? Because you can see price has not really make a decision where it wants to go. It's going up and it's coming down, it's going up, it's coming down. Price has not really made a decision on where it wants to go. So this here, this is a perfect example of a ranging market, because you can see price going high, low, high, low. There is no clear higher, 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 low. Here it seems like price wanted to go high, then it went back low. So this is known as a sideways market, and it is in this market that we want to stay away, right? Especially if we see this in the lower time frame, we want to stay away from this market and wait for market to form a clear direction. Now, how do we identify when a downtrend has shifted to an uptrend? We can identify that through a market structure shift, also as how I explained in the previous video as a CB1. You can see it in this example where you see price here is making a low, a lower high, a lower low, a lower high, a lower low, lower high, a lower low, and price does not makes a lower high. It instead makes a higher high, breaking the previous high. Okay, so you can see here price breaks this previous high and it continues higher. This is an early sign that the trend is going to change. Okay, instead of forming lower lows and lower high, price forms higher highs and higher lows. So this is when we know that the trend is about to change. This is an early sign. Okay, a shift always comes before a new trend starts. So here you can see market was first making higher, lower lows and lower highs, and suddenly price starts forming higher highs and higher lows. So from this we can see that the structure has shifted and the trend has reversed. Market structure is important because it helps you understand the structure, it helps you identify the trend and predict where price is likely to go next. Okay, so that is about market structure. So now that you have understand market structure and trends which we have, let's dive let's dive into it even deeper. Okay, I want to introduce two more new concepts on this channel, which is something which is used in the market. If it is the FVG and STH STL and ITH ITL. Let's start with FVG. Okay, so FVG is a three candle pattern which forms in the market when price moves too fast. Okay, if you look at the current market, we can see there is an FVG over here. There is a fair value gap here. Okay, this is known as a fair value gap, where the first candle can be any candle. Okay, it can be an up candle, it can be a down candle, and the second candle has to be an expansion candle where it trades, it expands, moving far away or moving away from the first candle's low or high. And the third candle has to, it can be any candle, it can be an up candle, it can be a down candle, but it should not close, it should not retrace till the level of the first candle's low or high. Okay, there should be a gap being seen in the chart, and that would be known as a fair value gap. Right, so what is a fair value gap? Fair value gap is an inefficiency in the market. Okay, it happens when the market is moving too fast, and we can use this fair value gap as a entry. We can use this for anything, if you ask me. Okay, it's crucial in trading, in my opinion, where we can use it for the direction, we can use it for buyers, we can use it for entry, we can use it for risk management. Literally everything you can use fair value gap. Okay, so that is about fair value gap, and we can identify more fair value gaps in the chart before moving forward. So we have another fair value gap. You can see here, this is also known as a fair value gap. More details on that in the coming videos, but this is also a fair value gap. Okay, and we have a fair value gap here. Okay, so these are fair value gaps where we can see a gap in the market. Okay, we can see that there is a gap between the first candle low and the third candle high. right? In this case, it's we can see a gap between the first candle low and the third candle high, right? Okay, so now that the fair value gap is clear, let's look at STH and STL. What is STH, STL, and ITH, ITL? STH, STL, and ITH, ITL may look like a complicated term or a concept, but it's just basically swing highs and swing lows in the market. Okay, where if you see here, this is known as a ITL. Why is it known as an ITL? Which also means intermediate term. Let me write the full meaning so that you can see. Okay, so this is the full form of ITL, ITH, and STL, STH. It means intermediate term low and intermediate term high, and short term low, short term high. Okay, let's see what is this intermediate term low and intermediate term high. Now here, right here, we have a low here. Okay, and we have another low here to the left of it, and another low here to the right of it. This low here, which is lower than the left and right of it, this is known as an intermediate term low. Why? Because it has a short term low to the left of it and a short term low to the right of it. So thus this is known as an intermediate term low. Right, and if we inverse that, we would get an intermediate term high, where for example this right here is known as an intermediate term high. Why is this an intermediate term high? Because we have a short term high to the left of it and a short term high to the right of it. This can say we can say this is a short term high. Okay, this is what intermediate term low and intermediate term high is. Now how can we use this along with our other concepts to profit from the market? If you see here, price is always moving from and towards the PD array. Okay, and this fair value gap, this intermediate term high, intermediate term low, short term high, short term low, these are known as PD arrays in the market. All right. Okay, so these PD arrays are what price moves from, and it is what price targets to. Okay, so let's look at another example. Okay, in this case right here, we can see why did price retrace from this level. Okay, what made price move from this level? We could see that we have a ITH here, intermediate term high here, and price after trading into this ITH, intermediate term high, price retraced, and it retraced from this level. Why did price retrace from this level? If we just go one time frame above, okay, this you can see this ITH which we saw in the lower time frame is actually a fair value gap in H4. So price respected this fair value gap and it retraced. Okay, it respected this PD arrays. In fact, there are two PD arrays here, one being the intermediate term high in M15 and a H4 FVG. So there are two PD arrays, which makes this very powerful. Okay, so price respected this and it retraced. It retraced for some time, and what did it retrace to? We can see that here we have a fair value gap here as well. We have a small fair value gap here. Okay, we have a fair value gap here, and if we mark out this low over here, and when we scale down to M15, we can see that price retraced from this intermediate term low ITL. So price retraced from this intermediate term low and this H4 fair value gap which we have lying over here. And if you guys remember this chart example, it's the same chart example as what we saw in the previous videos, where it's also a, if we draw out this Fibonacci level, we have a CB1 here. So if we check out another reason why price retraced from this level, we can see that price retraced from this 261 level. Can you see the confluence over here? can you see what happens when we combine all of these concepts? We get to enter high probability trades, because we are not just entering based on random. We are not just entering randomly. We are entering based on these confluences, these powerful confluences which make our trade high probability. Okay, so in this case, the discount array is the intermediate term low. Okay, the PD array, the discount array is the intermediate term low, and after we reach this intermediate term low and we sweep this low, we can now target this intermediate term high to be our next target, with which price, okay, can trade towards. So this now becomes our target, and we look for an entry once we get a sharp turn to the upside. Okay, once we get a FEG in and out to the upside, we can already start looking for an entry. So here, if you see here, we have a in FEG in into this H4, FEG into this swing low, into this ITL, and we have a 261 level here. So when we get a CB1 here, we can already start to look for an entry. So this, once price broke this level over here, this high over here, we can start to place our buy order targeting a 1 to 2, which it hit the take profit. Alright, this is one example. Let's look at another example. So we can see in this example, we have an intermediate term low over here. We have intermediate term high. Okay, and we have a short term low, and we have a short term low here, right? So in this example, you can see that we are sweeping this low and we are continuing higher, we are targeting this intermediate term high. Okay, so here, once we get a sweep here, we can identify what else is in this area for us to look for a buy. So before price reach here, we can anticipate and look for an entry here. So when we see here, we have a CB1 here. Okay, so you can see that this 161 level is overlapping with the intermediate term low. Okay, so that is one confluence. And when we when we scale up to H1, there was a fair value gap here. Okay, so this is a mitigated fair value gap. So a fair value gap can only be traded into one time, and once that fair value gap gets traded into, we have to look. This no longer becomes our PD array. The next PD, this no longer becomes sensitive. So the next sensitive point becomes the swing high or swing low, which gets traded back into the fair value gap. So in this case, we have a swing low here. So this is now our PD array. This is the sensitive area which price can react to, and you can see that price swept off this intermediate term low before it continues higher. And where can our entry be in this case? Once price swept this low, we can already start scaling down to M15 to see for our entry, or we can wait for, let's say we are waiting for the higher time frame. We see that here we had a H1 fair value gap here. Okay, we have a small fair value gap. So through this fair value gap, since we have not hit the target yet, so through this fair value gap, we can look for an entry in the smaller time frame. So we can go to M15 based on this H1 fair value gap. We wait for price to get traded back into this H1 fair value gap, and we can see price took some time to get traded back into this fair value gap, and wait for an in and an out. Okay, so here we have a in and out here. Okay, this could have been our entry. We can place our entry here. Okay, let's just place our entry at the fair value gap, and stop loss covering the low, targeting this high. So here is another. So this is another trade which we took just based on our knowledge of intermediate term high, intermediate term low, Fibonacci, and fair value gap. So this is how you can combine the concepts and take high probability trades. Okay, if you are interested to study, I do recommend studying this on your own, and you can be applying this in your own trading. Go look at the charts with the same principles we just went over, and see if you are able to understand what is happening. And don't get frustrated if you are not getting it the first time. This really comes with practice, and mainly it comes with screen time in live market. You have to be seeing this in the live market for you to really see the pattern, see the formation happening in real time, and only that way you can make your own understanding, as that is where you can find your own edge in the market. So I hope this video was helpful and valuable for you, and I will see you in the next video very soon. Thank you.